We start off with what could be a make-or-break moment for the rally. There are just two and a half trading days. We only do this because you guys hate the song.
Name the band.
I don't know.
Europe.
Okay. 4 days until the Fed decision. Markets are pricing a 20% chance of a rate cut in June, a nearly 90% chance in July. This as President Trump doubles down on his criticism of Fed Chair Jerome Powell and pushes for him to cut rates. And today, we saw semis get crushed on trade, disappointing data from China, the 10-year yield near lows. Is this the perfect recipe for a rate cut? What does that mean for the market? Guy, welcome back.
Thanks, Mel. It's great to be back. I missed all you guys.
We're glad you survived the Dominican Republic.
I was in the Dominican Republic.
That's why you missed everyone. You were in the Dominican Republic.
Crazy places to go. With that said, I mean, scarier than the Dominican Republic, in my opinion, is the fact that the Fed would even consider cutting rates. And the fact that President Trump is saying they should cut rates is, to me, it's madness at the highest level. I still think the market is pricing in way too dovish a Fed. I think the Fed can only disappoint next week. And I'll say it again. I think the market's toppy here. The VIX at 15 in this environment makes zero sense to me.
Yeah, Dan?
Yeah, listen, I think that we can look beyond June. We're not going to get a cut next week. So it really comes down to July. And at that point, we're going to know what the outcome of, if there is a meeting between President Xi and President Trump at the G20 at the end of the month. And then we're going to start to get more earnings. And that really could dictate whether or not we have that hike at towards the end of July. So to me, we're going to talk about semis a little bit. I expect some other pre-announcements before Q2 ends. And if there is only a kick-the-can sort of announcement on trade, I think that's a sort of thing that investors will start to price a higher likelihood of a cut. But if we don't get it, that's where it's lights out again to the downside.
I think no matter what happens next week, the market moves higher. I think because first of all, it's only 20% chance that we do get a cut. So
the Fed sounds hawkish in the press
Well, I don't think he's going to sound
conference.
hawkish. They're actually going to tiptoe their way into a cut.
Okay, let me
that
clarify.
patience
If the
word
Fed
is going to be
doesn't
removed.
sound
That's the chatter.
As dovish as the market wants it to sound, which equals hawkish.
Yes.
Then that would be disappointing.
I think they're supposed to. The consensus is they're going to remove the word patience out of the language. If they don't remove that, that would be the equivalent of being hawkish. But I think no matter what, market moves higher from here. This is Goldilocks.
The last two Fed meetings have been disappointments from a market perception, again, relative to what expectations were. So I think the bond market at 208, look, the 10-year, to me, screams no growth. And a growth scare is much worse than an inflation scare, even though the long end of the curve supposedly is supposed to reflect inflation expectations. What's going on here right now is I think people are probably pricing in a hefty part of global central bank easing. And the reality is what the final easing is going to be is not going to give you anything back. The dollar was 55 basis points in the dollar index higher today, bounced off that 50-day, looks like it's reasserting itself. That's not good for risk assets. Dollar yen is also actually moving at the same time in that direction. Look at commodity prices, look at anything that's reflation oriented, and it's telling you it's not a great time to be in anything cyclical.
I mean, look at gold.
Well, gold is the opposite side of that coin.
Yeah.
And gold has had this stealth rally. We've been talking about it for a while. The gold miners have done well, and the gold to commodity is at a level now we haven't seen in quite some time. In my world, it's about to break out to the upside, and it's done that under the auspices of a dollar that's actually been pretty strong until recently. So if this dollar does weaken in a meaningful way, which it probably should, I think gold takes off the upside. Gold is telling you, in my opinion, that the equity market is way ahead of itself.
The equity market is above all its moving averages, though. So I look at it, and I agree. There's a lot of things that are negative, a lot of things that are headwinds for the overall market. But the market is telling us something. It wants to move higher. It's shaking a lot of this stuff off.
How is that telling us that it wants to move higher?
2% off all-time highs.
Just because it's 2%
above all
off
moving
all-time
averages.
highs?
It shook off all of trade concerns. It's shaken off all of growth concerns. We've had global growth concerns for quite some time. All it cares about is the Fed and whether the Fed is hawkish or dovish.
But Steve, just the last two times the S&P has been approaching 2,900. It was January of 2018, and it was then fall of last year. And what happened? You could have made the same argument. I'm not telling you you're wrong. I'm just saying that those narratives were that was the more constructive narrative about the S&P making higher highs. So if we're right back at that same spot, the risks are increasing for that growth scare that Tim's talking about.
I don't disagree with you. I think we've shaken off a lot of those concerns from the last time this happened to now. But if the market does make new highs, I think the bear story has to sort of go on the side and say, okay, we're all missing something. If the market makes new highs coming out of this meeting and the market starts to slow grind in the summer environment higher, makes new highs, I think we're missing something.
So, by the way, when someone says, I don't not agree with you. So when someone it basically means they're not agreeing with you. I don't disagree with you means basically I don't agree with you at all. If we think about the Fed, and Steve's actually right. Fighting the Fed has been
Thank you.
Steve's once again correct here. Fighting the Fed has been a losing proposition for 10 years. Okay, so to the extent that we've seen this before, where people have questioned earnings capacity of companies, people have questioned the global economy, we've seen the stock market to continue to chug along. So to the extent that I don't believe you can see the S&P go careening down, certainly to 2650 is probably the one level everybody's targeting if we actually have a real, that's a 5% correction. My point is simply, I think positioning, expectations, and sentiment right now are the biggest issue. The economy is not the issue. It's all about where positioning is, and people are positioned on the bull side.
So we have a treacherous calendar in the next few weeks. How do you position yourself? I mean,
I think you want to be defensive. I mean, I do disagree with Steve about being constructive on equities here. I get it. There is no alternative. We have rates where they are, and we know that we have a dovish Fed. They are not going to turn back to being hawkish, which was where they were in December of 2018. So that's not happening. But I think the interest rate market has already moved ahead of that a little bit. Okay, and I think that there's a potential. You use the term Goldilocks. I'm not so sure that makes a whole heck of a lot of sense. My biggest risk is if we look back to 2015, when we had the 10-year yield below 2%, we had equities were much, much lower. We had a dollar that was strengthening. We had commodities going lower. And a lot of the same things were in place. I just think it's not a Fed policy mistake right now is going to happen. It is a protracted trade war that could just deflate the global economy, which is very fragile right now.
So when I say Goldilocks, I mean if we have a weaker economy, then the Fed is more likely to cut rates. If trade talks go south, the Fed is more likely to cut rates. If we have a stronger economy, the market moves higher.
Can the Fed save everything?
The market told us last week that the only thing that they care about, or 2 weeks ago, the only thing they care about is where the Fed is positioned. They don't care about trade. The market rallied in positioning, got so short off that recent low that I think the market was caught off sides to the bear side.
Look, we've created another asset bubble, whatever you want to say, and the Fed has targeted asset prices. So it's not going to happen tomorrow. And if you think about what happens when growth, we talk about this triple B threat of where the biggest tranche of debt exists. It's one notch above junk. And for a lot of companies, if we go into a protracted growth dynamic headwind, I do think you're going to start to see credit issues that become not just significant, but very significant. We've seen moments where the credit markets in the last 6 months, especially during periods of liquidity drying up, have been devastating, frankly, to the downside. But in the short run, look, the reason why the Fed's not going to cut is because the economy is not cratering right now. The leading indicators are not your friend, but the overall dynamic in terms of consumption trends, and even if you looked at the ISM services, it wasn't that bad. Manufacturing's not so great, but if you look at the Fed surveys on a regional level, they've been telling you that CEOs and companies and hiring is cautious based upon trade dynamics. It's not telling you that their businesses are falling apart, and there's no place for the Fed to cut. It gets back to positioning.
If the Fed doesn't cut, the markets will probably sell off.
That's
right. Okay. And if there is a trade war, then the markets will sell off. So is the risk to the downside?
Didn't the market sell off already on the trade?
Look where Mel put you, Steve.
I know.
She gave you no room.
So if I agree with her, I lose. But the markets, we already played that act before.
Have we really played?
Well, we've had a trade war.
Round of tariffs on $300 billion.
We've already had a ratchet up. If you think that the market hasn't,
we haven't had that though.
Do you think that the market hasn't? The market is a forward pricing mechanism.
Judging from Broadcom's full-year sales forecast, the market has not incorporated that into their thinking.
In the semis, everyone was thinking about a back half of the year that was going to be better than the first half. So what happened is they supplied up a lot, and then the back half, if that doesn't come through, they're going to get hit.
I guess
but you know what?
My argument was that would be the most obvious group to respond in advance to $300 billion.
We're just digesting some of those right now.
And they did. The semis started selling off last June. They led the market pullback. They were the first to sell off.
So let me just tell you a couple things that I see. So you asked, where do you go in this market right here? Look at Microsoft, which is a couple percent from its all-time highs. The thing rallied 10% in a straight line over the last week and a half or whatever. That is a defensive trade in my opinion. That's like going into gold or something right here. Look at the other names that act really well. We talked about them last night on the show. Walmart, Costco, Target. These are all fairly defensive sort of names. Now, ultimately, ultimately a trade war will hit them. But this is the most important thing to me about the Broadcom warning last night. We are seeing the disruption. We are seeing the headwinds of the trade war in the supply chain. We're not seeing it at the finished goods level, which is why some of these retailers are trading so well in a defensive manner. And I think that's really what's going to weigh on the stock market as we get downbeat earnings guidance for the back half of the year because of the uncertainty about the supply chains and the disruption from the trade war. And that's what weighs on the stock market.
Yeah, I think with each passing day, we're less close to getting a trade deal. I'll say it again. We're 16 months into this U.S.-China thing, and I don't think we're any closer now than we were 6 or 7 months ago. And despite what President Trump says, I know he says, when there's a deal to be made, I'm ready to make it. I don't think that's true. I think the Chinese hold all the cards. I'm probably one of the only people that think that. With that said, if you want to be someplace, big cap farmers traded okay. And I'm telling you, gold miners are going higher. They're breaking out to the upside. It's a levered way to play gold. And the fact that Procter & Gamble is trading where it is, to me, that's actually really scary. Procter & Gamble at all-time highs trading 24 times forward earnings makes absolutely no sense to me.